I'm Chris Reddick, founder of Chris Reddick Financial Planning. Today I want to talk about one of the trickiest parts of retirement tax planning. These are called Roth conversions and IRMAA. A Roth conversion can be a very powerful strategy. You move money from a traditional or a 401k into a Roth IRA, pay taxes now, and then that money can grow tax-free for the future. But there's a catch. If you convert too much in 1 year, you may increase your income enough to trigger IRMAA, which stands for Income-Related Monthly Adjustment Amount. In plain English, IRMAA is a Medicare surcharge. If your income crosses certain thresholds, your Medicare Part B and D premiums can go up. And here's the frustrating part. IRMAA works like a cliff. Going just $1 over a threshold can trigger a full surcharge for that tier. Another important point, Medicare uses a 2-year lookback, so your income in 2026 can affect your Medicare premiums in 2028. That's why Roth conversion planning is not just about asking how much can I convert. The better question is how much should I convert while balancing taxes, Medicare premiums, and long-term retirement income. In many cases, the best opportunity for Roth conversions is after retirement, but before Social Security and required minimum distributions begin. This is sometimes called a golden window. Your income may be lower during those years, giving you more room to convert at lower tax rates. But you still need to watch your Modified Adjusted Gross Income, or MAGI. For IRMAA, MAGI includes things like pensions, Social Security benefits, IRA distributions, Roth conversions, capital gains, dividends, interest, rental income, and even tax-exempt municipal bonds. So the first thing you do is estimate your income for the year before any Roth conversions. Second, look at the IRMAA threshold you want to stay under. Third, calculate how much room you have for a conversion. And fourth, compare that number to your tax bracket. You may not want to convert so much that you jump into a much higher tax bracket or a much higher IRMAA tier. That said, avoiding IRMAA at all costs is not always the right answer. Sometimes it may make sense to accept 1 year of higher Medicare premiums if the Roth conversions helps reduce future required minimum distributions, lowers lifetime taxes, and creates more tax-free income later. The key is to think in terms of lifetime tax minimization, not just minimizing taxes this year. This is especially important for married couples. After one spouse passes away, the surviving spouse usually files as single, which means a narrow tax brackets and lower IRMAA thresholds. This can create what is sometimes called the widow's penalty. Roth conversions, while both spouses are alive, may help to reduce that future tax burden. So the takeaway is this. Roth conversions can be valuable, but they need to be coordinated with IRMAA, tax brackets, Social Security pensions, and required minimum distributions. I usually recommend reviewing Roth conversion opportunities every year, especially in the fall when your income picture is clear. If you're retired or approaching retirement and wondering whether Roth conversions make sense for you, visit my website or contact me on the page below to learn more. Thank you for watching.